Well, we're going to move straight into another discussion for you now with FIIG Securities on rates outlook. Mark Todd is with us for all of that. Mark, from where you sit, the idea of pricing in more cuts and bringing those forward, those expectations, what's been your view in the last 24 hours?
I think, Carson, that we were expecting this sort of cut to come through. It makes sense for us to believe that the Reserve will continue to hold the line for the course of next year, 2012. I can understand your previous interview around the pressure on the banks. I don't see the RBA making that signal to lower those rates further. I think they'll have other tools available to them. It's not just going to be in the cash rate, it'll be some other pressure. They will continue to jawbone if they need be to say that the economy is in good shape. People should start going out to lend and borrow and do all their natural business behaviour.
But it's not going to do what it said on the tin, is it? Quite frankly. It's wholly deflating. Everyone's expectations are raised and now dashed.
That's right. It was very sad for them. I'm sure everyone's going to expect, Gail Kelly and co to, give us 25 basis points, and she hasn't yet come out to the market. So I think they would be sitting in a lot of offices in Sydney and Melbourne saying, how are we going to sell this? That's the issue. The NAB sold it well, saying we have still the lowest rate. I don't think that sale will work again. NAB's divorced from the other three. We now have a circumstance where everyone's in offices saying, what's our marketing message? The message is clearly, you need to go the full 25 basis points. I think they have always been very poor in explaining the cost of funds. It's that dreaded offshore. What is that? If you look at the bank's funding, 52% is in term deposits, 48% is in the offshore piece. They're constantly saying, Steve Minchenberg, it's offshore is going really badly. You can make it 60-40 on the term deposit piece. We're seeing some term deposit rates where the majors are paying 6% for 6 months of cash. So they're pretty good rates when you consider that a mortgage is 6 3/4. There's not much spread. So when they talk about the cost of funds, it's the margin between the mortgage and the term deposit, or their general cost of funds. So there's avenues to increase term deposits to improve their funding. But the reality is, if you want lower mortgage rates, it's very hard to get higher term deposits. So I think some of the rates we're seeing right now in term deposits become quite compelling.
Tell me about the compelling nature. It seems heresy of buying sovereign debt right now, ex-Australia, and ex a lot of countries with our enviable debt to GDP ratio, which is about 25%. But if you look at, say, even now, sovereigns in Europe, would you be minded to go in at these levels, believing that European central bank will make a move in the right direction?
Well, we've seen in the form of supras, so the supranationals, so the cross-border borrowing entities, we've seen a great rally in those assets as people come to the conclusion that Europe will resolve its problems, with Germany being dragged, kicking and screaming to the table through S&P, that will see those supras become quite attractive rates. At one stage there last week, supras were trading at higher rates than Stockland. So you were able to buy these incredibly good investment grade assets that have been going for a very long time. EIB, set up to refund Europe, was trading at 8%. And Stockland was at 7.5%. So, it is extraordinary times that needs that capacity to step back and look at the end borrower, the end issuer, and say, well, that makes a bit of sense. I can put $100,000 to work on that asset rather than having a term deposit at under 5%. But the reality is, I think we're in a low growth environment. We're going to have lower rates over the next 2 to 3 years. So I think if you see 6% for some very good credits, it's probably a great opportunity.
Mark Todd from FIIG, appreciate it as always. We'll talk again sometime soon.
Pleasure. Take care.